Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. Thank you so much to all of you that have checked us out at Jazz Wealth. It's been some time since we've been accepting new clients as we built our own portal in our background here. Your own client-facing portal. We built our own CRM, we're our own sort of classroom and everything. And we're just trying to do things a little differently. And all the software that other advisors use is like, wow, whatever. It's so boring. So we built our own. Anyways, thank you for that. I'm going to help you out today a little bit, and this one was tough. I was thinking the other day, if you haven't noticed, all week we're doing videos on inherited IRAs. It's something that's coming up a lot and something that will come up eventually for some of you. So what's the strategy there, right? I get this question all the time, and everybody's a little bit different, so this one was kind of tough to figure out. How do you make a video that helps the most amount of people but still makes sense, right? So the question came up, well, how do you invest an inherited IRA? And so we have to make some assumptions here. So there's a different treatment for the way you may inherit it, right? You could inherit from a spouse, which I hope doesn't happen. You can inherit from family that is non-related, and you can, not non-related, but family that's not a spouse, I should say. Non-family, it could just be somebody that leaves you an IRA. And there could be others too, but this treatment here we covered the other day, a little bit different. Let's pretend you're a younger person, and by younger I mean like under 50, right? You're just a younger person, and you inherited from grandmother, mother, somebody like that left you an IRA, and let's say it has $200,000 in it, right? They spent a lot of their dough and through retirement, but they've got $200,000 there. Well, all right, so you are getting this now, and you probably know the rule. You've got 10 years, assuming the person was of age, right? You've got 10 years basically to pull that money out. Now, if that person happened to be your brother and the age was really close, there's some rules there. But just in general, this is grandmother leaving you an IRA. So you've got 10 years. You have to pull the money out. And so people say, well, all right, that's going to be taxed at some point. The first question I always ask is, well, you didn't know this money was coming, so does this help you in some way achieve a goal that you would set out to achieve? Were you planning on buying a property, paying off your house? Did grandma say anything to you about what she wanted this to be for? And if that's the answer, we can start strategizing investments. Often what happens is people go, man, my uncle died and I didn't realize he had me as one of the beneficiaries, and I'm getting $200,000. How do I invest that? I don't need the money, but I know I got 10 years. Well, generally, I tend to say, swing for the fences. Be as aggressive as humanly possible. I don't mean bet it all on Tesla, Bitcoin, none of that. Now, just careful. I mean aggressive growth funds. Spread out, diversify. Our funds here, we manage our own funds. So we have small cap funds, large cap funds, aggressive growth funds, things like that. What if we just be aggressive with it? And you think, Dustin, why would you do that? Why do you want to take risk with all that money? Well, because there's two things that can happen. So, and this is not for everybody, I totally get it, but you've got $200,000. And if you invested aggressively, we know there's basically two things that can happen. It can lose value pretty aggressively, or it could gain value, right? If it gains in value over that 10-year period, which statistically it will, then you have to pay tax on the 200 at some point. Well, that extra money could just help you pay tax. So if you average the 7%, or it's actually 9%, but we say 7 for inflation, then you go, okay, cool. That's a little bit of extra money. It's not going to offset all your tax, but great. That means you may end up with closer to $200,000 after taxes versus just leaving it sit in cash. Well, what happens if it falls? You say, well, grandma gave me 200. Have you seen the stock market lately, right? We're down 20%, or basically down 20%. So now you go, oh, crap. Now grandma's 200 is worth 160. That makes me nervous. Wait a minute. If we don't need the money right now, and this was for something in the future, you're living your life, all is good. If you don't need the money and it falls to 160 temporarily, why not take a chunk of that out and put it in an individual account, right? You're going to pay lower taxes. I know I didn't spell that right. You're going to pay less taxes on some of what you pulled out. The balance is smaller. The rest can continue to grow back over the 10 years, but the IRS is going to see a smaller number. See, maybe you take out 30,000, I don't know, right? Well, this 30,000 a minute ago was worth 35, this little chunk of it. Let's move it over here, reinvest it the exact same way, and that money will grow back as the rest of this money grows back as well. So now the IRS doesn't care anymore. They got their tax on that, right? So that's my first sort of thought when somebody says, I don't need the money, but how do I invest it? Swing for the fences, and hopefully there's a moment where things go really, really badly because we can show the IRS a smaller amount. We know it's going to grow back, and we know the rest of the money is going to grow back, but for that brief moment, 160 was your chunk, not 200. Not that you would take it all out, but you get what I'm saying there, right? So that's why I tend to lean that way. It's not a good fit for everybody because some people, maybe need the money sooner than 10 years, but over 10 freaking years. Imagine the moments in time that are really weak and really exciting. It's going to happen again. It's currently happening right now in the stock market. So keep that in mind, right? If you inherit an IRA, let's talk about how you should invest that money. And if you want to talk about it, at jazzwealth.com, we can actually help you out there. We don't do the sales pitch. We have nothing to sell but ourselves. If you're just curious how it all works and you want to know if maybe we're a good fit, you can schedule a call, right? I promise you we will not even mention anything to offer some sort of pressured sales tactic or anything. I despise that, how the other places do that. We'll just talk with you, and if we're a good fit, we're a good fit. If you decide otherwise, we'll send you on your way. We're just happy you're watching. Enjoy the rest of your day. Thank you so much for hanging out with us here. We'll see you on the closing beat a little bit later, huh?
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.